Hello, everyone. I hope you're doing well. Today, we are going to be discussing why insurance companies are confusing at best, uh, misleading slash disingenuous at worst. So, if you've ever looked at a brochure for any of your participating policies with any of the companies, whether it be Equitable, Sun Life, Manulife, Canada Life, any of the companies that would be traditionally used for IBC or infinite banking concept or just cash value whole life insurance, you are going to see charts and tables that look something to this effect. You are going to see that the 10-year average return with respect to the dividend scale is 6.44%. And you're going to go, wow, 6.44% return is fantastic. You're going to look at, you know, one of this from Sun Life here, and you're going to go, geez, 6% with, the tax free slash tax deferred um, process that whole life insurance allows for. And you're going to sit there and go, this is absolutely incredible. Further, if you look at Equitables, and let's get this out of the way over here, you're going to see, alrighty, look at this. We've got, okay, your average return here on the Equitable, let's follow this down, over 30 years is 7.86%. In the last 5 years is 6.17%. And you go, geez, this is absolutely fantastic. You go, over, I don't know, many, many, many years, a 6% compounded return is absolutely fantastic. You're comparing your different policies and you go over to Canada Life here, and you see again, you've got some pretty solid numbers, 5-6% rate of return, or at least the interest rate. We'll get to that in a second. But here's the truth of it, okay? The dividend rate is not the internal rate of return that you are going to receive in a policy. This is particularly important for new folk that are unfamiliar with whole life insurance. The dividend rate is the amount of money that the insurance company ultimately will, pay you to be part of a policy holder. All right. However, it is not the net amount because there's fees, there's expenses, the whole 9 yards that come off of this. When you actually look at a real policy, so this policy here was based upon, it's just a equitable life policy. It's their wealth accumulator platform. It's a 35-year-old male, non-smoker, 25K per year premium with a maxed base premium versus EDO payments, essentially using their own individual calculator, just so you know what I've estimated here and what I based this on. But when you actually look at the internal rates of return, for the first 10 years, your internal rates of return are not phenomenal. Now, I actually think they're pretty darn good considering the fact in the first year you're taking a 20% hit. And you're growing it, and at year 10 you're getting a 3.28% internal rate of return, which is different than an average. But moving down the policy, you'll see that you kind of are in this range of 3 to 4 what is it, 28% rate of return. This is your actual return you're going to get in your policy. If dividend rates drop, you'll see that there's 2 different columns here. It is a far cry, a large stretch, if you look at Equitable's dividend scales, dividend rates here from 7.86 or even 6.17 in the last 5 years, or heck, even 6.05% in 2022, or the most current dividend interest rate scale of 6.2%. What I do think you should be aware of, though, and what you should look at on these charts, and most of them have this, is they look at the standard deviation, and thus, the difference in the returns, and ultimately, you could see this as the risk profile. When you look at Equitable, it gives you a very nice chart here, and we'll look at the S&P, the TSX total return index, and you'll notice that the standard deviation is 16.14%, quite a bit, well, over tenfold as risky as the whole life. And in fact, the standard deviation really talks about the difference in the returns. Which have largely decreased over time, as you'll notice. Just equity returns over time have yielded less amounts, and insurance companies typically invest into more fixed income assets. But anyway, that's a whole other topic for a whole other video. For example, 5-year GICs, they've been historically dropping, and you'll notice kind of the same with the par account and ultimately the dividend scale interest. But anyway, so yeah, just be aware rather that your dividend rate is not your internal rate of return. It is a far cry from it. If you start thinking that you are going to get a 6% rate of return, you are sorely mistaken. However, do realize that the internal rate of return is largely impacted by your first couple of years when you're capitalizing your policy. You should not be looking at a whole life insurance policy for the purposes of making significant investment like returns. In my opinion, a whole life insurance policy should be akin to a savings account that gets you a phenomenal return for the interest that most savings accounts return. Have a great day. Let me know what you think.